Once again, it's Bring Your Own Topic Day, where Roshan, Adrian, and Eric each bring a subject they think has relevance for our listeners today. These have to do with fundamental and technical investing, the use of the high yield spread as a guide to setting expectations about where markets may be going, and finally, how to understand the taxation of bonds that you might buy at a discount. Stay tuned for all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Eric Olson and Adrian Nicholson. Eric, how's your week been so far?
Oh, fantastic. I got a couple days in Dallas. It was so chill. Left in, I think it was freezing temperatures, returned to freezing temperatures, but enjoyed a really nice stay. How about your week so far?
It's been great so far. Been busy, a lot going on with the Fed meeting, inflation report, so a lot of work to do for us. Adrian, how about you?
I'm going strong. Happy to be here as always. Can't complain too much with this week. Towards the end of the year, it's typically a busy time with a lot going on, but I can't complain too much. A lot of good things going on my way. And like I said, I'm just going strong and feeling good and ready to dive into today's podcast. Looking forward to it.
Yeah, we've got some great topics for you today. We decided to each come up with our own topic and bring it to the group as a bit of a surprise. We did discuss it before because we needed to do some research on it, but we'll go over all those today. Adrian, why don't you start us off?
Yes, I'll be happy to take the honors and start us off today. Appreciate that, Roshan. So I recently got a question, and I thought this would be a good way to address the topic I'm going to talk about today. And the question was, how do I decide what stocks to buy and when to buy? And that's a pretty long discussion, especially if you ask that to any of us here. We could probably spend a lot of time just going over that. But I'm just going to break that down into two investing methods that can help answer the question on what stocks to buy and when to buy them. That is fundamental and technical analysis. So these are two investing methods that investors and traders use for researching and forecasting stocks and their prices. And like any investing strategies, there are people that are for it, and there are some people that are going to be against it. So there are definitely going to be people listening to this podcast that are saying, Adrian, why are you spending time talking about technical analysis? It's a waste of time. And then there's also going to be people saying, why are you talking about fundamental analysis? That's a waste of time too. So I thought this would be an interesting topic of discussion today to break down what fundamental and technical analysis is and what are some of the advantages and disadvantages of them. So I'm really looking forward to just diving a little bit deeper into this today for our listeners and our viewers. So I'm going to start off with fundamental analysis, just going over the definition and what is it. So fundamental analysis is a way to evaluate a stock in order to determine what its intrinsic value is. What is the stock really worth? And so there's a lot that can go into it. And there's also a macro way to look at it as well. What's the overall economic impact on this stock? What industry is it in? You can break it down further and looking at, let's just say it's an individual company. What's the financial strength of the company? Who runs it? The management, the executives. That's also something that gets baked in on the value of the stock. Also, a big thing, profits, revenues, and earnings. Is the company making money? That's one of the biggest things now in today's market environment, companies that are making money. And there's a lot more layers that can go into it. I'll just list off a few: expenses, assets, and liabilities. This all gets baked into the fundamental analysis when it comes to reviewing a stock. You guys want to touch on any other definition for this that I might have missed or that you think will help clear this up for the viewers before I go over the advantage and disadvantages?
Well, to me, the first thing that comes to mind is different investors can use different data points and come up with different valuations, right? So what one person uses for their fundamental analysis, someone else might totally disagree with, and you're going to go into technical. Some technical guys won't care about the fundamentals at all. So I think it's worth noting that the fundamental side, especially when you're trying to find a stock's intrinsic value, there is art involved in that. And if you go back to Benjamin Graham, just because a lot of the father of value investing, he would always talk about when you're investing, invest with a margin of safety. Meaning, if a stock's trading at 15 and you think it's worth $16, that's probably not a buy in the Graham world, right? So I'd say just realize it's not an exact science. You're not going to come up with a number there that is sort of true forever. It's true for right now based on your analysis.
That's a great point.
Yeah, fortunately, with all the data that we have available today, it's and the computing power that we have, it's been increasingly possible to say, if we have a thesis that of the thousands of data points that we might have about the fundamental attributes of a company, which of these are at least statistically significant in separating the minnows, from the fish, or the frog from the tadpoles? We're essentially trying to say, is it, for example, some sort of attribute of management, or can we even measure that? What is it precisely? Usually, the things that have been tractable, if people are familiar with that term, the things that are at least subject to quantitative analysis. Sometimes if there's a little bit more confidence or around the conclusions that have been drawn concerning these, whether for the good, yes, they are relevant, or no, they aren't very useful as discriminating between one company and the other. But these are largely some of the ones that you highlighted there initially, Adrian, which have to do with profitability, with return on invested capital. Can a company take a dollar of capital, whether it's earned or it's borrowed, and put it to good use? And if the answer is yes, then maybe so. It's one thing that I heard very interesting in a presentation by Dan Rasmussen. I think it was Dan Rasmussen recently, was talking about the concept of the moat, and of which you may be familiar. This is one which is attempting to express in quantitative terms somewhat a truly qualitative attribute. Do you have some sort of edge against your competition, which makes it difficult for them to enter into your competitive space? And if the answer to that is yes, then presumably you should have pricing power. And so what this group of researchers did, which I don't think Dan Rasmussen and his team at Verdad Capital did the research, I think he's just reporting on it, but it found that, wow, interestingly enough, if you look at so-called high moat or wide moat companies versus narrow moat companies, during at least this period of analysis that was part of this study, it was the narrow moat companies that actually had the most the strongest overall growth rates, which just completely defies the logic. So I guess I would say I do think there's a lot of value in fundamental analysis. I think it's also important, though, to subject the fundamentals that you're positing have discriminatory power, and again, between the good and the bad companies. Test it rather than just accept it at face value.
I did not expect that outcome from the study, Eric. When you were talking about it, I'd like to send that over to me. I want to read it.
All right.
Yep. Send it to me as well, Eric. And you both really drew on one of the disadvantages for fundamental analysis, where there's just, especially when it comes to a company, there's just so much information on just companies, and it can be easily confuse and complicate when it comes to researching on what may be the driving factor that will send this stock price higher. So finding a specific entry point and exit point for a stock, just using fundamental analysis and just using all the available information, can just make things very complicated and very exhausting. So that is a drawback that you really just need to consider if this is the sole strategy you want to use. And since I went over a disadvantage, I could just go over one more advantage for fundamental analysis, that it can just really pull back the curtains and really explain sometimes the price movement of a stock. For instance, you could have this company that has this really great CEO that everybody loves, and he makes a lot of money for the company. And unfortunately, they could just get hit by a bus and they're no longer here anymore. And that could just send the stock price crashing. Technical analysis really won't paint that picture for you. You could be looking at it and be like, why is the stock price going down? But that news, that information, that that instance that happened could really, really paint the picture and show you why something happens to the stock price, not just looking at the price movement.
Well, and I'll tell you, with the both disadvantages and advantages, I almost argue a little bit and say, well, technical's intent is never to tell you why, right? Technical intent is directional price movement.
Mm-hmm.
So they're not telling you why the price is moving. They'll often talk about supply and demand. And whereas fundamental, going back to your disadvantage, I don't think the intent of fundamental is to tell you a specific entry point. It's to get you a valuation. Here's what I think the stock's worth, and then typically you're using a margin of safety to buy it significantly below that valuation, right? So going to my example of, let's just say we think a stock's worth $10. You're not buying it at 9. Usually you'd want to buy it at 7 or below from a fundamental perspective. If it's at 7 and that's your price, that the price you're willing to buy it at, the fundamental analyst is not going to look at the chart and say, well, it's at 7 now, it could go down. They would just say, here's a price I'm willing to buy it at. It's at that price, let's buy. They're not really looking at charts.
Good point. So let's just move on to the definition of technical analysis then, Roshan. This is just identifying opportunities for a stock price by just looking at statistical trends. This could be the stock's price, its volume, looking at an overall stock chart just to determine that entry and exit point for a stock, where you look at certain patterns that are happening right now. Just historical price patterns is a very important indicator when it comes to technical analysis. And some of these indicators are simple moving averages, support and resistance levels, trend lines, and momentum indicators. So just diving a little bit more deeper into these indicators and what they are. Simple moving averages, these are averaging the daily prices over a fixed period of time. And having a cross above or below one of them might be an indicator on whether you should get out or get into a particular stock. So this really addresses the when to buy a stock. And again, there's a lot that goes into this, but this is just something that you can use as a data point with helping out your overall decision-making process. Now, for support and resistance, if you don't know what that is, this is, again, looking at and utilizing price pattern and price history, where a support level is when demand is strong enough to stop the stock from falling further, where resistance is a barrier where sellers impede the price advancement of a stock, where you see a stock going up and it gets to this level that it may have gotten to before, and the stock falls down where these sellers get in. Again, this is just another indicator you can use to help with your decision-making process on seeing what would be a good place to enter and exit a stock. Do you guys want to touch more on the definitions before I go into the advantage or disadvantages?
I don't think I have much to add to the definitions, but I have a lot to say about the applications of it. I do think it maybe is just to acknowledge that different technical systems do exist, and some of them will blend one or more of these following ingredients, and others say that one or more of these following 3 ingredients is irrelevant, but they are price, volume, and time. Price, volume, and time. And so, and all of the derivative indicators, technical indicators that we talk about are fundamentally derivatives of those things: price, volume, and time. One system that I think is kind of interesting. Are you familiar with? Oh, now I'm drawing a blank on it. This is point and figure. Point and figure. There we go. Are you familiar with point and figure charting?
Yes.
So that is essentially saying we don't care about volume. It's just price movement, and it treats price movement in time as not that salient. It's really only, in fact, it doesn't scale to a time-based grid. It's just looking for a certain amount of movement of price, and then that's it. So I think it's interesting to see how different people combine or leave out these fundamental building blocks.
Great, yes. And I'll move on to the advantages and disadvantages. I feel like I'm taking all of our time. I know you two are itching to talk about your topic, so I'll just power through the advantages and disadvantages so we can go right into it. And one advantage that I think is a really interesting one is how technical analysis can sometimes be a self-fulfilling prophecy where you have a stock chart. You can be looking at the price pattern for a certain stock, and you have just millions of people around the world that are looking at the same chart as you right now. And sometimes they all are basing their decisions off of different technical indicators, whatever it may be. But if all these people see a certain exit point for a particular stock, it could send that stock farther down where this self-fulfilling prophecy is just reinforced and happens. So that could be an advantage that people can see when it comes to technical analysis, where a lot of people are just looking at the same data that you are. And then the last thing I want to talk about is just a common disadvantage for technical analysis. This is that it's a very lagging indicator. You are using historical price patterns and volume or whatever it may be to try and predict what the future stock price may be. So that's one of the drawbacks people have for technical analysis. But the theme is really the same. There are advantages and disadvantages to both these investing methods. To solely use one can be difficult, not impossible or unheard of where you just can't make money. But having a blend and just having certain principles built into place where you are using these to base your decision can always help out in the long run.
Yeah, I agree. I think the those are definitely good definitions, and as Eric mentioned with point and figure charting on both sides, fundamental and technical, those are like umbrella definitions or categories, and there are a lot of different ways you have investment styles within them, a lot of different ways you can, a lot of different ways people have made money in the market. So I think part of it is figuring out what fits you. I've mentioned what I call your investment personality type before, and I think one of the things that a down market will do is it'll help you figure out who that is. If you're finding that you were someone trading on technicals before and the markets have pulled back and you've lost some money and really uncomfortable, maybe you're not a technical person. On the flip side, if you find that you created this intrinsic value and bought a stock below what you thought the value was, and now the stock dropped at 20, 30, 40%, maybe that's not the right person or investment strategy or personality for you. So I think part of it is figuring out what's a good fit for you as an investor. And gentlemen, Eric, why don't you jump in your topic next?
Sure. Well, so since we're talking about investing topics today, or at least I am, we have over the last probably year and a half, something like that. I think it's maybe the last year, been periodically checking in here about one of the areas of price activity that I've been following, and that is the price activity that we call the high yield spread. Again, for those listeners that are hearing this for the first time, what is that? On any given day, you have someone who's investing in the bond market has a choice of a lot of different things they could own or not own. Those would go from the extremely safe, namely probably treasuries would be considered the most safe of all, or they could go to the strong but not necessarily quite as safe. Those would be investment grade corporates, or they could go to where they think they might find even more compensation into the bonds issued by smaller, less established, more speculative companies that have to offer higher interest rates normally when they issue their bonds in order to induce people to come invest in those rather than invest in the safety of treasuries. So on any given day, you can say, well, now they've already been issued and various traders are trading them back and forth. What are potential buyers of a high yield bond requiring that they receive an additional compensation to purchase that from another current owner of that bond? Well, it will depend, won't it, on whether their outlook is on the economy and on the markets for that matter is fairly peaceful, and they think reasonably safe, that's a reasonably safe environment ahead for those same small companies, or if they think those companies are probably facing some headwinds and may actually just go bankrupt and disappear, then of course they're going to say, buying a bond from a company that might not be here when that bond is supposed to mature and they're supposed to pay me back, that might not work out so well. So on that basis, you can see the additional amount that these buyers or prospective buyers of these high yield bonds are requiring can flex. Sometimes it'll be relatively small, 2.5%, 3% more than I'd get on a treasury. Other times it might be 20% more than they would receive on a treasury. And that's not just 20% until it matures. That's 20% per year until it matures, if it matures. So we're watching that. And we have done an episode or two on this subject. This, again, credit where credit is due. This stems from a blending of some concepts. One from, again, Dan Rasmussen and Verdad Capital, that which itself borrows to a certain extent from Ray Dalio and Bridgewater and others. But in essence, what this is saying is when the members of this space, this bond market space, are let's say requiring less in compensation than they normally have over, let's say, the last decade, we're going to say that they are more optimistic than normal. And then we make a second observation: are they getting increasingly more confident, or are they increasingly more anxious over, let's say, the last 3 months? And when you put those together, more anxious than normal or less anxious than normal over the last decade, and increasing in their confidence or decreasing in their confidence, you put those two together and you have a 4-phase model. Well, right now, using the data that the St. Louis Federal Reserve issues every single morning, we are at a point where, and we've been here since about Thanksgiving, thereabouts, we're at a point where you can say we're in that phase where, yes, we're slightly above normal. The anxiety level is slightly above normal, but for sure it has been, their confidence has been growing over the last 3 months. We nickname that recovery. And that has historically been a period in which small cap value has really thrived. We're potentially days away from we're so close to that 10-year median number. We're so close to that. I wouldn't be surprised if in the next week or two, I'm not predicting it, but I wouldn't be surprised if in the next week or two, we actually see the members of that marketplace more confident than they normally have been over the last decade. And if their optimism continues to increase, we'll say, hey, you know what? This is not only time to be on small caps. Now it's probably time to put even a heavier emphasis on large caps. This is what I find so interesting about this method, this high yield spread method. It touches on what you were saying, Adrian, about using price, but it's the price not of the instrument itself, namely stocks, that might be of interest here. Instead, it's looking to an entirely different marketplace and seeing what price action in that marketplace reveals about psychology, and then using that psychology as a framework for structuring decisions you make about investing not only in bonds, but also stocks, and some commodities. So anyway, I find it fascinating. It's been very interesting to see if you use that as a check on your thinking about what's taking place in the market generally, whereas the commentary is largely about, well, maybe the Fed is going to slow it down, and the commentary is, well, maybe we have a recession in 2023, and the commentary is, well, maybe the market has more downside. If you juxtapose with that, hey, but if you look at the bond market, the institutional investors in the bond market, it appears that they're feeling increasingly chill about all of this, and more confident. How should I use that information? I think it's an interesting component and input into your thinking.
So, Eric, I've been looking forward to asking you questions about this. It's not one
Yes,
that I track readily, but this is the ICE B of A US High Yield Index Option Adjusted Spread.
correct.
So the question I'd have is, so it looks like I see the slowing down you're talking about. It looks like it peaked at about 5.8 in July. Then it went way down to about 4.2 in August, went back up to 5.5 in September, and now it's come down to about 4.34. So my
Yes.
question about that is
Mm-hmm.
could this just be a false move? I look at the markets and it seems to anxiety did seem to peak in September, calm down. And the way I'm viewing it, not from this index at all, I'm just wondering if they line up, is that I think it's starting to ratchet back up. I don't think it's going back down. Just with the what happened with the Fed meeting, with what's happened with the markets, with the I believe it was Tuesday when the inflation report came out, the market shot up in the morning and gave back 2/3 of the gains by the afternoon.
Mhm.
So I'm wondering, could this be a false indicator right now and it turned the other way?
Well, the short answer to the final question is absolutely yes. It can always be it could be mistaken. Remember, this is aggregating the behavior of largely, I say, institutional money managers, because how many I've used this example with my clients in these conversations before. Have you ever been to a party? Let's say a dinner party or a cocktail party where someone sort of humble brags about this or that stock that they've made a lot of money on. Yes.
Yes.
Yeah.
Have you ever been to a party where somebody has humble bragged about the high yield bond on which they made a lot of money?
No.
No. And what does that tell you? It tells you that retail investors, for the most part, pay attention to stocks, but not to bonds. As a result, what that I think we can conclude is that for the most part, the retail investors have vacated the entire playing field of the high yield bond marketplace, at least being students of it in that way. And as a result, what you're seeing then is the revealed behavior for the most part of just the institutional players who, as a group, while of course they're finite in their cognition and finite in their knowledge, and they're also emotionally wired, as are we as retail investors. Nevertheless, on balance, they're more disciplined, more analytical, more structured in their approach to things. And so as a result, I think this reflects more of their analysis than just purely their emotion. So on that basis, can they be wrong? Of course they can be wrong. But then coming to the other question that you had embedded in your larger discussion there, Roshan, was the question of whether or not, in fact, it's reversing. And I want to make sure I'm using I'm tracking your pronouns in there. Do you mean when you say it, are you talking about the high yield spread is reversing and going higher again? Or are you talking about, no, generally speaking, the psychology of the markets right now is such that it looks like the psychology is deteriorating insofar as we can see in the stock market reactions to the recent Fed announcements haven't been enthusiastic?
I am, yeah. So the answer to your question is actually yes to both. I wonder if this is a little bit. Um, i- are we going to see a bottom in this spread and see it turn up just based on, and that's and we don't have a crystal ball, and as we always tell people listening, we're not giving you advice, we're giving you things to think about. Please consult your advisor, financial advisor, your tax advisor, consult attorneys, any that apply to these topics. But I'm wondering if, similar to what happened, excuse me, uh, in August when it sort of bottomed and shot back up, are we looking at something similar? Are we
It's
retesting that bottom, so to speak?
Oh, that's certainly possible. That is certainly possible. I will say in this case, I don't really predict so much as I react.
Okay.
So I speculate about where it may be going, but in terms of how it drives my behavior in this respect, I am at this point being fairly disciplined about what I do or don't do in response to it. And I also look at it this way: I don't need to be right every time. I just need to be right some good portion of the time. And particularly, I need to be right early enough before giant downturns, as well as right early enough before giant upturns. And if I can participate in not all of, but most of the big moves in the right way, then that's probably going to be rewarded over time.
I may have this source wrong, but I think it was the Rothschild that get credited for some quote. They're a very wealthy family, bailed out governments before. They
Mm,
had said that, and once again, if I'm right about who it is, they had said that they just wanted 60% of the move. They didn't mind missing the
mm,
bottom 20 and missing the
mhm,
top 20. They were
mhm,
trying to get that 60% of the
mhm,
move. Also reminds me of a Lynch quote where he had said something to the effect of, "You only need to be right 7 out of 10 times."
mhm,
So for it, to give you that market beating track record. So
mhm.
I think that lines up. You had mentioned you're not typically predictive. You're more reactive to what happens. You're reacting to it. Are there any? You're not taking any actions now, though, right? You're saying you feel like we may be getting close to an action point, but we're not there yet.
Well, let me clarify that. In one sense, no, I have been taking action. So the week of Thanksgiving, I shifted out of a very defensive mode for those of my clients that have said, yes, we think this makes sense to manage a portion of our assets. Let's say, 10%, 5%, 20%, whatever the number might be, using this more adaptive model. Then the week of Thanksgiving, what we did is we shifted out of the full protective mode into then the full ambitious growth mode. And it may be, as I said, in the next week or two that we make one more little tweak to go from a predominant focus on small cap value to a predominant focus on large caps.
Yeah,
At the same time as the rest of the world is saying, the sky is falling.
Yeah, you talked about two things I think we should do an episode on there that are important. One is
Mm-hmm.
what reactions and what moves are happening in various strategies right now. I'd be very interested to discuss that with you.
Mm-hmm.
The second one is the opportunity potentially in that small cap space.
Mm-hmm.
And what leads me to that is just my own fundamental analysis. When I'm looking at stocks, I'm seeing some attractive valuation in that space. Next, I recently read a GMO had their fall conference in November, and they released the data points in the notes, and they were also talking about attractive valuation in the small cap
Mm-hmm.
space. Prior to that, I think it was Bank of America released that they are there opportunities to get about a 12% annualized in that small cap space. So
Mm-hmm.
I'm seeing a lot of things come together around small caps and opportunity, and typically after a market decline, they lead us out. So I'd love to dive deeper into that. I won't talk about that anymore because of limited time today, and I want to jump into my topic if that's okay with both of you.
Yeah,
Yes,
please.
of course. Go ahead.
So this is an interesting one. I had thought I found something. I realized I was wrong about finding something, but I still think it's worth discussing after research. We are going to delve into some CPA space right now, so I'm giving that disclaimer. Please talk to your CPA, talk to your tax person. We are not tax people. We're not tax preparers. We're just looking at strategies that are out there for investors. So the strategy we were looking at was um, or I should say, I was looking at, not giving either of you the title of being wrong on your analysis, but the opportunity I was looking at was we're coming out of this era where you have really low interest rates. I'm looking at treasuries out there paying 0.125% a year, right? And so, right as rates
Previously issued ones, you're saying.
correct, thank you for clarifying. Yeah, previously issued treasuries paying 0.125, and so you can buy them to get a year. These are 1 year out treasuries. You can buy them where you're getting well over 4.5 plus yield. And so my thought was, well, can you buy them and pay ordinary income on the 0.125 and then get a capital gain on the remainder? And so many sources I said yes. And then finally, with the help of Eric and Adrian, we did a lot of digging and we found out the answer is no. So
Roshan, let me just clarify one thing further that you
please.
said. So our listeners might be scratching their head on one of those things. And that is, so Roshan saying that you have a choice today. You could go buy a freshly minted US Treasury bond that's going to be paying you over the course of the next year in excess of 4%. You could do that. Or you could go buy a previously issued one that has as its stipulated rate of interest only 0.125. You might be saying, well, why would anybody do that? Well, because they're going to sell it to you for less than its face value. So that you're between now and a year from now, you'll make the same amount of money on that as you would on something that's issued at let's say 4.5%. You might be thinking, how can something that pays you 0.125 earn you the same 4.5% as a freshly issued one? The answer is that the other seller has to sell it to you at a price low enough to induce you to buy that from them instead of going and getting the other. So it's the price appreciation from your purchase price until its maturity price that adds to that 0.125% payment that gives you a total return of 4.5. Now, Roshan, take it from there. Why is that not a more tax advantageous approach as we thought it might be?
So, and I'm just going to say it a little bit differently than you, and my numbers won't be exactly right, so it's just to estimate it. But
Okay.
let's say you spend a 950 for this $1,000 bond.
Mm-hmm.
When it matures next year, you're getting 50. You're going to get $1,000 back, so you made $50 there. And let's also say, because I use the 0.125% interest, that you're getting it'd be $1.25 in interest in that 1 year for the bond. So my thought was, am I paying ordinary income on the $1.25, which is a higher tax bracket, and then a capital gain on the $50 when it went from 950 to 1,000? And we found out once again that that's not the case. We had to do a lot of digging. There's an IRS publication 550 where they talk about this, and they say, no, you've got to pay ordinary income on that $50, the gain from 950 to 1,000. And as we discussed it, we thought, well, what makes sense in that scenario is the fact that the government's saying, well, you could go buy a freshly issued bond paying that 4.5, so they're not going to give you better tax treatment, because then everyone would go after those other lower bonds out there, those lower price discounted bonds. Now, there are situations where there would be capital gains treatment. Please talk to your tax advisor about this, because this took a lot of work for us. But that's typically if you sell it above par. So usually you're not getting a capital gains treatment on anything below par. Once again, par in this example being $1,000. The bond was originally issued at 1,000 in this example, and you're buying it below par at $950. It gets really complicated. Please talk to your financial advisor, talk to your tax advisor, and we're there to help if you've got questions. But sometimes when we're coming up with these topics, it causes us to pull on a thread and do a lot of research, and we find the answers.
And Roshan, I want to just extend this because which is a great discovery. I want to apply this then to the area of tax-exempt bonds. And some of our listeners may be saying, what are you talking about, tax-exempt bonds? These are issued by municipalities generally, and the federal governments and the federal government and the state governments have a deal. States say, okay, we won't tax your bonds if you don't tax our bonds. And they said, deal. So if then a state issues it, or a city issues it, or some other district issues it, a bond, the federal government says, okay, by our agreement, we're hands off on that. So for whom does that make sense, since they usually pay less interest than regular corporate bonds or treasury bonds do? Well, it makes sense for people who are in a really, really high marginal income tax bracket, because their tax equivalent yield might actually be better owning that municipal bond than owning a regular taxable bond issued by a company or owning a federally issued bond. So now, though, when you introduce this element into the story, namely that you buy at a discount, and that discount, the recovery of your price back to the maturity value of par, that part isn't tax exempt. That part is treated as ordinary income. And so I had not understood that before. I guess I'd never even thought about the question before. And as a result, now I have to say, oh, then maybe you really, for your high marginal income tax clients, want to stay very far away from so-called tax exempt bonds that are trading at a discount.
And what you just described, that's how sometimes you can have scenarios where you've got a tax exempt bond fund, and then you end up paying taxes on some of them because they could be trading these types of bonds. So that's definitely an interesting topic. Interesting to go through and research this further, and see what's out there.
Now, Roshan, you had gift bags for our clients, our listeners, before we leave the episode today. What's the gift bag, or what's the dessert liqueur, or the port wine we're drinking here at the end?
Well, I did have another topic that I was toying with as well, which was just talking about the Fed and inflation in the market. So Tuesday, I had mentioned this day earlier when we were speaking about it. Tuesday, we had an inflation report come in for November. It was also the first day of the Fed meeting. It came in lower than expected. The markets early in the day, the Nasdaq and S&P were both up about 3%. They both ended the day, I think, up around a 1 or a little bit below 1%, that followed by Wednesday when the Fed announced they're raising rates by by half a point, where they've been doing the last four straight meetings. They did it at 0.75%. To me, what stood out, and I think what everyone was looking for, well, what's Powell going to say after? And there are a couple things that stood out. Is he said that they're not going to consider slowing rate cuts until they're confident inflation is moving down to 2%. They're not confident yet. Now that doesn't mean they're not gonna go from a half a point to a quarter point. They could, when they keep raising rates, but that's not necessarily what the market wanted to hear. The other big piece of negative news, I really think there's two worth noting. One is that the median forecast of peak interest rates was 4.6 back in September. It's 5.1 now. And if you go back a couple weeks, Powell said that in his speech where he all but announced, we're going to do half a point. He said more than likely. Everything else in his speech was pretty um, negative news, because he had said they're going to likely have to raise rates further and hold them there for longer. The final point I will mention on here is unemployment still below 4%. You're still having a lot of labor inflation, service inflation, which makes up more than half of the index while people are paying for services, continues to go up as well. So we had an episode a few months ago where I had said I'm concerned about the markets. I'm concerned they're going to head down. I'm concerned we're going to enter a recession, and unemployment is going to go up. I stand by that. Now, if you check the receipts and the dates and you did not listen to me, you're actually slightly ahead right now than where you were. But I believe that's just market fluctuations. And what happened on Tuesday morning, I was really grumpy because I was feeling really wrong. And then when it gave up two-thirds of the gains, I thought, oh, maybe I'm not wrong. And then I looked at my research further, and it made up. So I've been on an emotional roller coaster this week. But with the point being with the Fed meeting is I think things still look bearish. And Eric, going back to your high yield spread, after you mentioned your thoughts as we were preparing, and I looked at it, I'm just when and the chart looks very different from the stock chart. It's kind of an inverse of it, but I would wonder, is that a bear market rally? If it was a stock chart, would I be calling that a bear market rally? So, gentlemen, any thoughts on the Fed, inflation, markets at all?
Well, I will just observe. First of all, Roshan, you basically said there that you were really grumpy because the markets didn't go down, and then you felt happier when they did because you felt vindicated. I just want to encourage you to have some emotional freedom from that.
Yeah. Well, and you know what? It's not. There's so much time, energy, analysis, and research put in, and
Uh-huh.
sometimes you're just wrong, right? I, and
Hmm.
I and I
Hmm.
and I accept that, and you've got to be ready to pivot from it quickly. And so that's more the feeling. I think it's more the fact that I'm looking at, and I'm like, how can all this analysis be wrong? Which, quite frankly, it is sometimes, right? You just
Yes.
gotta live with
Right.
it and move on. But that's what I'm looking at. So yeah, sometimes my ride home is to calm down and get me back to normal before I arrive at home like a madman.
Well, okay. I'm going to say that there's a few things that I find encouraging.
Yes.
So, which, again, I've been saying for a long time, and I'm not normally a fence sitter, but I've been saying for a long, long time that I've been a fence sitter on the question of recession in 2023. And then once I saw the 10-year versus the 10-year Treasury yield versus the 3-month Treasury yield go inverted, where again the 3-month is actually rewarding you more than the 10-year is paying you. I thought,
Yeah.
okay, that coupled with the previous observations we'd made about other of those pairings, the 10-year and the 2-year, et cetera, I thought, okay, we probably are going to be in for a recession, but I'm still not convinced that it's necessarily a recession the way we usually think about it. I'm still observing the slack labor in this economy, and how the fact that the number of jobs on offer versus the number of jobs being filled is still crazy high. And you have, while the labor force participation rate ticked up a little bit, you still are not seeing, you're still seeing, what was it, 200 last month, I think it was 250 some thousand jobs were created. It's the unemployment numbers are still low. It just doesn't have the kind of ring to it like we usually think about the antecedents to a recession. So on that basis, I'm somewhat optimistic about it. And then the other thing I'll say is that you are seeing some prices come down. So let me just say, when prices come down, there's two ways of thinking about that. We all understand the concept of inflation. Prices are rising. When prices are falling, we call that deflation. When we see prices not rising as fast, we call that disinflation. And so in this case, we've been seeing certainly disinflation. And then actually in some cases, we're actually seeing deflation. So let's give an example. Used cars, I think, are down about 15, 16% lower. They're priced 15 or 16% lower this year than they were at this point last year for comparable age and mileage and such. So that's something happening. I think you're also seeing, depending on the market, in some cases, you're seeing prices softening for housing. So I think that will take some pressure off. I think goods, in the area of goods, we're seeing inflation of core goods. So leaving out food and energy, and so goods, not services, I think are the year-on-year inflation rate for those was not even quite 4%. I think that's a positive. So at a lot of levels, I'm seeing things that make me say, hey, I don't, it's really hard for me at this point, at least, to have the view that we're just all set up for these really atrocious economic and market times ahead. And I know some of the big financial institutions I'm seeing are saying, yeah, brace yourselves, guys. This is going to be unlike anything you've ever seen before. And I'm thinking, yeah, it might be unlike anything we've seen before in how gentle it is. So I could be really wrong, but boy, oh boy, is there a lot of divergence in the commentary around what lies ahead, what awaits us in 2023.
A few things I have similar thoughts to on you. I don't necessarily think it's going to. I think we're sort of halfway through it in my opinion,
Mm-hmm.
and so we do have some more pain, but I don't. I've read a lot more bearish cases that I don't tend to agree with. The
Mm-hmm.
other thing that's sort of shifted in my thinking is a point that Adrian had brought up, which was a great one, which is what happens when when the Fed pivots, you tend to see a further decline. And the data is accurate. How I think it may not apply in this case, though, is typically if you look at the dates of those Fed pivots, there's something going wrong economically, so they had to ease to help the economy. And
Mm-hmm.
in this case, I think there's unless there's some external thing we can't predict, if it just continues on the path it is,
Mm-hmm.
that when the Fed does pivot, it's going to be because their job was done or they think it's going to be done, not that they necessarily need to support the economy that has something causing it to go down.
Mm-hmm.
So I don't necessarily think that that's something that shifted in my thinking after doing some additional research. So I hope that I'm wrong and we don't have that downside, and I will quickly adjust and shift as needed. But I still believe the fundamentals that are pushing us down are there. Although I don't necessarily think it's going to be as bearish as a lot of the cases I've read and seen out there. And I've seen a few optimistic ones come out recently as well. I think it was Goldman Sachs that came out with a fairly optimistic outlook for next year, and I believe they're the first like big name bank I've seen come out with more of an optimistic outlook.
Mm-hmm. Mm-hmm. Well, it's funny, we're never wrong. We're just early.
Yeah.
Which means in many cases we're actually wrong. But you know what? I think that if in our listeners can accept the fact that they, all of us, that's just part of life, is getting it wrong, and getting it wrong some proportion of the time. But as you said earlier, if you can get it right just a few more times than you get it wrong, and you can usually get it right around the bigger things, you'll do okay.
Yeah, and you limit that as well, right? It's uh, just reread an old investment book I'd read. It's Monish Pabrai's Dundo Investor, and he talks throughout the book of heads. Yeah, heads I make a lot of money, tails I don't lose very much. So
Mm-hmm.
if you're in that kind of investment scenario, well, if you are wrong, you don't lose very much, and if you can shift and adjust, sometimes it's just a matter of admitting this was wrong and make the shift and move on. In this specific case, and please tell, I'd love variant views on my thoughts, but just going back to the basic investment adage of don't fight the Fed, I feel like they're still trying to push things down. So, don't fight the Fed. It'll still potentially continue. It might break down to that basic and analysis, and everything else is just additional work to make me feel better, potentially. Gentlemen, anything to add? Not For all of our listeners, thank you for joining us. We hope you enjoyed our topics today on technical and fundamental analysis, the high yield spread, uh, corporate and treasuries available at a discount, and their taxation. As I said, once again, talk to your tax advisor, talk to your financial advisor. We closed out with the markets, and we'll be back next week with another great episode. This has been the Retirement Lifestyle Show.